Closing bell on Wall Street, and now it's market domination overtime. We're giving you full team coverage of all the moves to get you up to speed on the action from today's trade. Lou Bassanese, Prairie Operating Company EVP of Market Strategy, as well as Yahoo Finance's very own Jared Blickery, joining us now to break down the moves today. Jared, my friend, let's start with you on that close.
Yeah, let's talk about Powell here. We got the Powell put in effect. A lot of traders love the hint at September rate cuts, and as that has been firmed, we've seen the Dow really come to life here, up 1.89%, 850 points. And let's take a look at the weekly total over these 5 days, a little bit less because it had been in the red yesterday, but up 1.5%. Same for the week here. We're looking at the NASDAQ. It was up today by almost 2%, but still in the red for the week. And the S&P 500 just barely eking out a gain for the week, up 1.5% for the day. And really the small caps stole the show, up 3.5%, a little bit more than that for the day. And we can also take a look at the transports. The Dow Jones Transportation Index was up over 3% today, and nearly that amount for the week. So regardless of the sector or the asset class you're looking at, we saw pretty bullish reactions today. Not in consumer staples. That's XLP down there, the only sector in the red here. But look at consumer discretionary. XLY up 3%. That is the best day in about 3 months. You'd have to go back to early May to see that. Energy up 2%. Materials right there with it. Financials, industrials, real estate rounding out the outperformers on that top row. And let's take a look inside the NASDAQ 100. A lot of green here, a lot of dark green. Tesla finishing the day up 6%. Amazon and Alphabet up 3% each. And let's just take a quick peek inside the semiconductor space, and we can see a lot of green and some dark green there. Intel up 5%, NXPI just behind it. Inside the software, we got a little bit of red action. Intuit down 5%, but Shopify up 4%, Adobe up 2.5%, Atlassian up 3.5%. Here's Zoom up 12.7%. Just saw that one on my radar here. I'm going to finish up by taking a quick look at crypto because there we go, crypto, because Bitcoin is now up 24% or 4% over the last 24 hours, and Ethereum up 14%. So stocks, crypto, whatever you like, seeing lots of big gains here.
All right, thank you, Jared. Lou, your thoughts on the moves today?
Yeah, I want to double down on the significance of small caps. We haven't seen rallies like this of almost 4% for the Russell 2000 since the COVID days. But what's also really interesting to me is the energy sector, right? On renewed hopes of economic growth. This is the most underweight sector in the S&P 500 at about 3.5%, the most undervalued at about 15 times earnings. So this could see a real move here higher, justified by the valuations in that space. So it's an interesting rotation as we head into the all-important earnings week for NVIDIA. I feel like it's always dramatic. NVIDIA is going to save the bull market. Maybe this time NVIDIA doesn't need to have that great of a report, but I think they're going to anyway. Should give this some more momentum.
Yeah, just to your point, Lou, Russell 2000 up 3.8% in today's trade. All right, we are heading back out to Jackson Hole, Wyoming now as the symposium wraps up. And joining us now, our Fed correspondent, Jennifer Schonberger, who is standing by with influential economist, former Federal Reserve Vice Chair, and Princeton professor Alan Binder. Jen.
Thank you so much, Josh. And Professor Blinder, thank you so much for sitting down with me here at Jackson Hole.
Very welcome.
Your reaction to Fed Chair Powell's speech, do you think that a 25 basis point rate cut next month is necessarily a done deal?
Not quite a done deal, but if you're a betting person, you should bet on it. I'm not a betting person on that. I think it's more likely than not. The reason I say it's not a done deal is the Fed has bored everybody to death by saying we're data dependent, data dependent, data dependent. They are, though, data dependent, which is why he keeps saying it. And there are more facts about the economy to come in before the next meeting, which could change it. If they don't change it, if it keeps looking the way it's been looking very recently, then I think they will cut interest rates.
To your point, if we were to see hotter inflation reports between now and the September policy meeting, does that take a cut off the table?
Yes, it could. Yes, it depends on what happens. Chair Powell, to his everlasting credit, always emphasizes the dual mandate. There are two objectives. So the more the inflation looks bad, as you were just suggesting, the less likely it is to cut rates. The more the real economy looks bad, and it's not bad now, but it's sagging a little, it seems to be weakening, the more likely interest rate cuts are. So it depends on the balance of those two.
And to your point, depending on the balance in the dual mandate, the chair did reference that there are upside risks to inflation, downside risks to employment. How do you see things now?
I think that's exactly right.
Which
And
side are
it's
you
not-
more worried
it-
about?
It's not, well, I just want to say one thing before. It's not a mystery. When the tariff policy started to be in place, never mind tariffs on penguins and things like that, but real tariffs, a lot of us, and certainly I, said this is a stagflationary shock. And what does that mean? That means it will both slower growth, real growth, and raise inflation. That's what's happening. Neither one is happening in gigantic magnitude yet. And we don't really expect it to happen in gigantic magnitude. It's more of a drip, drip, drip in the wrong direction on inflation, up, and a drip, drip, drip in the wrong inflation on real growth, down. And that seems to be what's happening right now.
And as you look out beyond the September policy meeting, if they were to do a rate cut, would it be a one and wait and see? Or I guess depending on how much deterioration we see in the job market, how could the outlook change there?
I think what they hope for is probably a one and wait and see. But when I say wait and see, not that they're agnostic on what comes next. If they cut rates, they won't be thinking this is 25 basis points and that's all we're ever doing. I don't think so. They'll be expecting that to be the first of several. But as the chair has also emphasized many times, with the economy in pretty good shape, unemployment in the 4s, inflation still in the high 2s or maybe 3, depending on the measure used, they're not in an emergency situation in any sense. They can afford to wait. And I think that'll be their attitude.
To your point, how are you looking at the economy for the second half of this year? Chair Powell did reference we've seen slower growth in the first half, 1.2% GDP on account of lower consumer spending, obviously pointing out the downside risks to the labor market there. You could slice it both ways, right, with inflation, to your point, and the slowing growth and lower job growth. But do you see a risk that the Fed could be behind the curve?
Sure. I don't think it's a high risk. But the way you posed the question, yeah, there is a risk. And we may find out. Let me be concrete. Suppose the next 3 months' jobs reports come in looking like the last 3 did if you average them, which is terrible. Then I think the Fed will conclude, yeah, we're behind the curve. That's not a forecast. That's what I think is going to happen. But that's just an example of how the Fed might get behind the curve. Or on the inflation side, instead of going up 1/10, from 2.8 to 2.9, if it starts going up 3/10, 4/10 a month for a few months, the Fed will conclude it's behind the curve on that score.
On hiking. Switching gears, President Trump escalating his threat to oust Fed Governor Lisa Cook. Curious how you view that and the implications for Fed independence.
I view it as disgusting, actually, and it's not quite comparable to trying to fire the chairman, which, as you know, the president has talked about, but we think has abandoned. I hope so. You never know with him, but it is undermining the Fed's independence. It's the same law that specifies a member of the board of governors, which she is, and which Jay Powell is, can only be dismissed for cause. And that's a kind of elastic phrase, but it generally means malfeasance or breaking the law or something like that. And if you start stretching the meaning of for cause, you start having the opposite effect on Fed independence.
Are you suggesting that perhaps he does not have the authority to do this?
Yes, but this is for courts to decide. It looks like very thin, to me it looks like a very thin rationale.
Professor Belarnger, we'll leave the conversation there. Thank you so much, as always, for your insight.
Good to see you.
Good to see you as well. Josh, I'll send it back to you.
Jen, thank you. Stocks soaring higher to end the week after Fed Chair Jay Powell opened the door to a September rate cut. Our next guest sees more cuts as one of many reasons to stay bullish beyond some of that seasonal summer chop. Joining me now, we have Talia Leger, the Wealth Consulting Group Chief Market Strategist. Talia, it's great to see you. So, of course, let's start with Jay Powell, Jackson Hole, Talia. Now, I had some very smart strategists on this show, Talia. They were sitting in that chair, actually. And I asked them, what Jay am I going to see on Friday? They said, Josh, you're going to see neutral Jay. It's going to be standing pat Jay. That is not what the market heard today, Talia. They heard policy pivot Jay. Is that what you heard?
I think Jay stuck the landing in Jackson Hole.
Yeah.
I'm a skier, so that's how I think. Strategy number one, skiing second. But look, judging by the reaction in markets, we've got rally in stocks and bonds, a sell-off in the dollar. I think he effectively brought the prospect of additional Fed rate cuts back onto the table, potentially as soon as September.
Let me ask you this, because I know there's a few different reasons you're constructive on this market. We can talk about Fed cuts, but what are some other reasons you say, listen, you remain bulled up, you remain long?
Yeah, well, I mean, look, the market has done just fine without Fed rate cuts, so the cuts are just icing on the cake.
Did it
here.
need it, Tally? If you had heard a neutral J, would that have been a problem?
Well, I think number one, to unpack the 12 or so catalysts, there's a lot there. So I'll just start with sentiment and positioning. Look, we've got persistent pessimism, which I think is very good from a contrarian perspective. Having said that, I do think that risk appetite is moving in the right direction, but we got a long way to go before we get to what I would characterize as overly bullish conditions. When we get there, I'll let you know.
What do you think, Lou?
No, I completely agree. I think the sentiment is constructive enough right now. If you look at the AAII surveys, you're getting a lot more bearishness baked in there. Earnings growth is double digit. We're getting clarity. That was something that came up in an earlier segment. Clarity on trade and tariffs. We can work with when we know what it is. It's the uncertainty. But then the big thing for me is that no one's factoring in the dual impact of AI, both the spending, it's now keeping pace with consumer spending in terms of the magnitude of it, but then also the deflationary impact from AI. And we're going to see that as we get into the back half of the year, closer to 2026.
You know, Tally, Lou mentions that big AI trend and theme. Next week, you have NVIDIA earnings on tap, the face of AI. How important is that print, not just for the AI trade, but the market?
Well, I think it's crucial, and we have been there, Lou, since early January. This is one of our favored sectors, whether it's declining recession odds, driving solid sales growth, apply some of the best margins in the market, that drives powerful bottom line earnings production here. And that's really the story for technology. And we get back to the blueprint from the mid to late 1990s. And I think that's the upside risk here that investors really have to keep their eye on.
Tally, when you outline all these reasons to stay constructive, and your clients come back and they say, all right, Tally, but what are some reasons I got to be worried? Would it be, on that radar of concern, would it be valuation? Would it be seasonality? What would you be calling out?
I think in the near term, to your point, it would be the summer kind of seasonal lull heading into September. And the one risk that I might point to as a potential negative catalyst would be a potential government shutdown. And how crazy markets are now, I don't think they're priced for that kind of a negative shock right here. Having said that, I do think that ultimately it will get resolved. And if you're buy the dips like us, I think it would be an opportunity to buy some of these cyclicals at lower prices.
And so buy the dips. And how do you want to be broadly positioned in the market right now, Tally? What sectors look interesting to you?
So I'm still sticking with stocks over bonds. Within equities, I still like the pro-cyclical economy-sensitive sectors of the market, including tech, old economy like industrials. I think materials is shaping up to be a big surprise for 2020. But also, dare I say it, consumer discretionary, I think, is benefiting from a lot of the tailwinds that no one saw coming.
All right, Tally, great to see you on set. And Lou, great to see you. And thank you for joining us. Appreciate it.
Good to be here.
Meme stocks are back, and the speculative pulse that we're seeing today looks a lot like the afterglow of 2021. It's not just price action, it's also pressure on management. And on today's Stocks in Translation, we're going to show you the heat, define the phenomenon, and then test it with Open Door. Now, here behind me is a heat map of today's price action in our meme stock basket that we first created in 2021 with a few updates. We've also seen many of these stocks perk up over the last few months, and there are lots of familiar names here, so let's try to spell out what makes a meme stock. And here we wanted to find the vibe without getting too dogmatic because there are lots of exceptions. But most meme stocks are consumer facing, or at least a familiar name. And when they first appear on traders' radars, they tend to be smaller companies with lower share prices. It also helps if traders are betting against them, so high short interest is another box check, maybe 15% if you're keeping score at home. And the most important criteria probably is heavy retail attention with a rip-roaring good story. Now, here we're looking at a chart of an index of highly shorted stocks from UBS. They're not all meme stocks, but it's a good proxy. And you can see that we recently hit the highest levels since early 2022. Now, we're going to want to watch how high this index climbs from here. But first, let's get philosophical for a minute. Why have meme stocks captured the attention of younger generations? Ed Elson, co-host of the Professor G Markets podcast, lays it out. His frame is very simple. The old menu feels closed, indexes are expensive, housing is unaffordable, and many of the most exciting companies, they stay private for very long times. He says we are locked out of the upside. So what do? We invent our own asset classes, crypto, meme stocks, anything that offers a chance at returns that we cannot access through traditional paths. Now, let's take a look of a case study here, and we're going to go to Open Door. Now, look at the year-to-date whipsaw from pennies to mid-single digits. It was down 99% from its 2021 highs, and now it's up multiple hundreds of percents off of its June lows, up nearly 40% today alone. That checks off a few of our boxes. It also helps explain why it's catching major retail attention. And now here's Anthony Pompliano with an interesting take. Pomp says the people calling Open a meme stock don't understand what's happening. Retail investors are now having a hive mind, working together to identify opportunities, take financial positions, and advocate for improvements at target companies. He goes on to say, it's like decentralized hedge funds with individual capital and collective intelligence. Product ideas are surfaced to executives and change is happening. He wraps up saying, the power of the crowd cannot be underestimated. Now it's scoreboard time. Let's measure what retail has advocated for at Open Door and match it with what has actually happened here. Now first, investors got the CEO switched out for an interim lead from product and tech. Check. They're also getting a renewed focus on AI, so check there too. As to the balance sheet, we'll have to watch future earnings releases to check that box, but bottom line, the executives are engaging publicly, which is not how things used to play out in the old regime. So let's zoom out here and look at the new playbook. Investors are organizing online to surface ideas. They accumulate shares, drawing the attention of leadership. Then they apply public pressure and they turn the screws. And if all goes well, not only do the execs listen, but they implement change. We saw some of this play out at GameStop and AMC, but to be fair, these two stocks have not become anything close to the poster children for turnarounds. So what's next for meme stocks, or should we say stocks that capture retail imaginations? First, we're going to need to keep tabs on that speculative fever, but you need more than momentum fuel. So does the C-suite actually respond to retail pressures, or do they just give lip service? Because at the end of the day, we want to know if we're all looking at a new activist force or just fuel for short squeezes. And tune in to episodes of Stocks in Translation, the podcast, for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Well, we're coming up on a busy week of housing data, new home sales, S&P Case-Shiller, pending home sales, and of course, weekly mortgage rates all on deck. Fresh data should give us key insights into housing activity and prices. This comes as mortgage rates hold steady at their lowest levels of the year. My next guest thinks this could be the time to buy. Join me now is Orfi Divangi, Zillow Group Senior Economist. Orfi, it is good to see you. So let's start on the big news today, Orfi. That was Jay Powell, Jackson Hole, seemed to be suggesting, Orfi, perhaps a policy shift, a policy pivot could be on the way. Let's say, Orfi, the Fed does cut in September. That means what for the housing market?
Look, it's really hard to predict where rates are headed. Remember that Fed cut last September? the 10-year Treasury yield actually increased after the rate cut. Mortgage rates increased by roughly 100 basis points. We're about 100 basis points higher by November. And so while mortgage rates have been on the decline since May, mortgage rates aren't expected to fall that far. Much of the yield curve already reflects expectations for 5 to 6, maybe Federal Reserve rate cuts between now and mid-2026.
So let me ask you, Orphy, I'm looking at the 30-year fix here at 6.52 according to Mortgage News Daily. As you're knowing, listen, this is tough. There's a lot of cross currents, but can we try and do an estimate here, a forecast, Orphy? Where do you think the 30-year fix could be in 6 months, 12 months?
Yeah, I mean, our official forecast is, 6.3, roughly 6.3, between 6.5 and 6%. But ultimately, given everything that I'm seeing in the market today, right, the inflation numbers ticking a little bit higher, the cooling of the labor market, I just don't know that the Fed will actually deliver the 6 rate cuts that are priced in right now. And so I think the risk is up, not down. And so, I would say to potential home buyers, people that are actually on the sidelines, but who can potentially afford to buy right now, this might actually be the moment, right? If you think inflation is going higher and rates could potentially still, the pressure is up, right? We got fiscal deficits, we got, labor shortages still, I would actually make the move now if I can afford it. The second thing is Zillow data shows buyers actually have the most options that they've had in a long time. One of my favorite metric is our Zillow Market Heat Index, and it shows the balance of power has kind of shifted from sellers to about neutral right now. And in some markets, buyers it's kind of a buyer's market, right? If you look at places like Dallas, Austin, Miami, Orlando, prices are actually declining in those markets, right? And buyers have way more bargaining power. They can get some big price cuts. Nationally, 27% of listings on Zillow had a price cut in July.
What does inventory growth look like right now?
Inventory, right, is up 18% from a year ago, and we now have the highest number of homes for sale since November 2019. So again, buyers have more options. There are more price cuts out there, and so if you can afford it, now might actually be the time.
Orphy, we've had some people suggest on the show, I'm curious to get your take on this, there's been kind of a generational shift that maybe younger Americans, relatively younger Americans, they don't see owning a home in the same way that prior generations did. Have you seen any research, any kind of line of sight there, Orphy?
Look, our Zillow survey data shows that most buyers actually look at both markets. Buyers, I think 58%, roughly 58% of renters today were looking to buy, right? And so, you have dual shoppers. People are constrained with affordability challenges, and so they're just looking for the best possible option. And so housing providers that deliver the biggest bang for people's buck are the ones that are going to be able to either sell their unit or rent their unit out, right? So remember, Zillow is now the largest rental marketplace in the country. And so we can see homes for sale, but also the rental market, and we can actually see where people are shopping and what they're actually looking at. And so you have a lot of dual shoppers out there. They're both looking at for sale options and at rental options and just trying to make the math work and get the biggest bang for their buck.
Great to see you. As always, thank you, sir.
A pleasure. Thanks for having me.
Going to do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of break, it's Asking for a Trend. We've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.